Alejandra, what do you make of the report this morning?
Yeah, well, thank you. Thank you for having me today, Oliver. It's
Thanks.
good to see you again.
Same.
Definitely disappointing. I know the number came in line with consensus. However, our estimates were for something much bigger than that. A lot of it was just based on the great ADP numbers we had on Wednesday earlier this week, as well as the ISM non-manufacturing report. Again, this is the services side of the economy, and there was a huge jump in the employment measure. So we were disappointed with the number, but again, it was in line with consensus. I would say if you want to look at the half glass full, at least it was positive. But other than that, definitely disappointing, at least on our end.
So we added jobs, to your point. At least we can see a positive number on the top. Average hourly earnings, also positive, basically in line. Our work week dropped a little bit. Alejandra, how does it fit in with the other stuff from this week? Jobless was better than expected. That print was pretty good compared to what we've seen during the COVID era, and private payrolls also were solid.
Yeah, well, in terms of the unemployment rate, yeah, I mean, I would say that came out as a pretty good number, but it masked sort of the underlying issue that the participation rate remained fairly low. People didn't join the workforce, which is a little disappointing. And overall, that keeps the unemployment rate actually lower. So it looks like a good number from the head on, but overall, it's not what we want to be looking at. And, especially if you even look at the participation rate, it's still significantly lower than what it was pre-crisis. And if you look at the number of people who are long-term unemployed, that sort of hovered around 4 million people. And the longer you are unemployed, the longer it takes for you to find a job, if a job at all. So that's a really disappointing reading from my end, for sure.
Alejandra, when you look at the data, you look at the COVID situation, what's the obvious remedy? I mean, does it seem still that these are jobs in the service industry that will come back? I know for the most part, when you dive into kind of the second order, these have been jobs that seem pretty directly affected by quarantine specifically. I mean, I know there's permanent job losses too, but how does that ratio and those trends looking, the permanent versus the temporary job losses?
Yeah, absolutely. I mean, if we've seen job gains since the worst of the crisis last year, pretty much most categories. But where you see the biggest deficit is in the retail, hospitality. And those were the numbers that actually went down again this month, which is, obviously really disappointing. And going back to the point about the average hourly earnings, people look at those numbers and they're like, oh, the earnings are pretty high. Things should look pretty good. But a lot of that is just a story of averages, because where we saw the big deficit in jobs and the big drop in jobs were in the lower paying industries. So the people who kept their jobs, obviously were tended to be more on the higher income side. And that essentially brought up the average.
Now, you mentioned at the top here that your team had a estimate for something quite a bit better. What do you think the breakdown was here? What surprised you in this?
Well, I think the biggest thing, because of the ISM non-manufacturing numbers, we expected a bigger gain on the services side. To me, this is just one of the biggest challenges of being able to come up with forecasts in the age of COVID.
All right, it's tough, right? I mean,
yeah, very tough.
Now, what does that mean, though, in terms of going forward? Do you still retain that optimism? Does this change the outlook, or can we say virus curves going down, vaccinations going up? If it wasn't a great number this time, there's a great one on the way?
Well, Oliver, I thought you made a really good point about the data this week. This was something that wasn't the best number in the world, but there were still some positive sides in, other data, whether it be the ADP, both the ISM numbers, factory orders. So generally, most of the numbers were, showing signs of a gradual recovery. Keep in mind that the market is also forward-looking. So, not only are we looking at economic developments today, but we're also looking at, where things will be 5 to 6 months from now. So, yeah, looking at the COVID curves and the new cases, they definitely are tapering. Also, if you look at the vaccination rate, last time I checked, I think the U.S. has about 10% of the economy, or 10% of the population vaccinated. This is actually quite good when you compare it to other developed economies. A lot of Europe, perhaps only about 3% of the population is vaccinated. So we are moving in the right direction. And then you and the previous guest mentioned the stimulus. So, going back to the unemployment number, maybe the lowish number was actually a good thing because it could increase the probability of the stimulus package going further.
So there's some things that are still working in our favor. Virus fight going pretty well. This fiscal side building. If we look at the charts on some of the data, I just grabbed some from your recent report here. Looking at manufacturing, guys, if we bring that up again, the ISM, I mean, it seems still that obviously with the problems in servicing and the services industry, we know that's weak, but the V-shape, very much a real thing for global manufacturing PMIs. How high do you think this could get, Alejandra, or do we see this maybe peaking out, or does this have another leg up?
We could keep on going. I would say one key country that I'm looking at least from a global figure, is the Chinese number. Especially from a manufacturing perspective, because the rest of the global economy actually does tend to follow Chinese manufacturing. They did experience a bit of a soft spot in January. It was still positive, but the rate of growth actually slowed. But there could have been a few one-off factors, whether it be, a slowdown in activity right before the Lunar New Year. They did see a fresh outbreak of COVID, so that also may have slowed activity. There was slightly colder than normal weather as well. But for the most part, it looks like the trend should remain in the upside. We're definitely seeing that in the U.S. economy as well. But to link that back to employment, even though manufacturing looks great, it's not a huge chunk of the U.S. economy. Services is much larger, and it's also not labor intensive. So even though we're seeing this nice rebound globally, both in the U.S. and global manufacturing, it's just, especially in the U.S., it's just not as labor intensive. So it's not going to be directly translated into a robust employment report. Where you see your more labor intensive industries are in leisure and hospitality. And that's where we're seeing some of the sharpest declines, or at least the biggest deficit compared to pre-COVID levels.
Okay, and those ones we should assume at some point are going to come back, hopefully. Alejandra, the last point on inflation, the kind of effects of all of this recovery. This is becoming a big conversation as the yield curve continues to expand, widen out. You guys have a lot of good detail in your research about the role of food in that. I want you to give me the rundown here as we go in. We got about a minute here. Basically, it seems like it's contained, but it could be building some momentum.
Absolutely. So, if you look at our outlook with respect to the U.S., we do anticipate a pickup in inflation this year, in consumer inflation. One is just the pickup in aggregate demand as we all get vaccinated and we go out in the public and we start spending. There's also a low base compared to last year. So on a year-to-year basis, that number will get higher. And then rising commodity prices. So you're showing right here food prices, but we're seeing it in oil and in the broader commodity complex. And then also other supply costs are increasing because of supply chain disruptions due to COVID. So we do expect a year-to-year increase in consumer price growth, not only in the U.S., but in other parts of the world. But one thing I do want to point out is one very powerful disinflationary pressure is operating below potential. So even though we're recovering, we still will have a negative output gap. And so if you have a negative output gap, that tends to be disinflationary. And according to recent estimates from the CBO as well as the IMF, the U.S. is not expected to close its output gap until at least 2025. Wow. So we might see some short-term increase in inflation, but looking at this 3-4 year period, we don't anticipate a whole lot of major upside because of that deficit.
Okay, great stuff, Alejandra. Great thorough discussion this morning. Great to have you back as always.
My pleasure. Thank you.